Do we all sound okay?
Yeah.
All sound okay?
You guys sound great.
Okay. Just go like this to
Okay,
me.
yeah, well,
Like,
I-
4, 3, 2, 1, 0.
I'm Tig Young, and this is the State Street Future State podcast. Each episode brings together expert perspectives on where the investment industry is heading and what that means in practice. We explore the trends, decisions, and operational shifts shaping how firms innovate, scale, and deliver value in a fast-changing market. I'm joined by my co-host, Anna Bernasek, Head of Insights at State Street. And with that, Anna, let's get started.
Well, it's wonderful to be here, Tig, today. And we're talking about digital assets. And as you know, digital assets continue to move from the margins toward core institutional markets. And one factor that's really shaping this transition more than any other is regulation. And today, we've got one of State Street's leading experts on digital regulations joining us, Justin McCormick. And we're going to have a great conversation around what are the key regulations that everybody really needs to understand and why do they matter? So full disclosure, I am not an expert on digital regulations. So I'm going to be asking a lot of questions. Justin, we're very glad that you're here on the podcast to explain everything digital regs to us. So welcome today.
Great. Thanks very much for having me.
So, Justin, I'm going to get going and just ask a sort of basic question, foundation question, which is really why has regulation become such a central part of the digital assets conversation at this juncture of the market's development?
Yeah, and that's a great question. And I think it's really now that we're looking at institutional adoption. And so the question isn't really is no longer can the technology work, but how can the technology work while satisfying requirements around customer asset protection, segregation, safekeeping, accountability, auditability, all of the things that the controls that an institutional investor is going to look for when deciding to adopt a digital asset model. We're also seeing an increasing focus on hybrid models in the digital asset space. And really, what I mean by that is you can have tokenized assets that can represent traditional financial instruments on one hand, things that can represent digital cash on the other hand. And those two instruments, while they're both tokens, they're regulated under different structures. So, for example, if you were in the EU, a tokenized equity instrument would be something that would be a financial instrument governed under the Markets and Financial Instruments Directive, the existing laws. But if you are digital cash that's a stable coin, you'd be regulated under the new legislation, the Markets and Crypto Asset Regulation. So that's kind of one aspect of hybrid. And then another aspect of hybrid is also where you have players that are investing both in digital assets and traditional assets and needing to ensure that those two markets work together clearly.
So, Justin, you've been following this space for a while now, I think more than 5 years, if I remember.
Yeah.
You were one of my first contributors to the Digital Digest, so I got that time frame in my mind. But can you tell us what's really changed most in the past sort of 12 months, 18 months that makes this conversation around digital regulations really important to have now?
Yeah, I think there have been kind of two key developments. And one is kind of really the shift into implementation. So in the earlier days of the digital asset marketplace, the questions were about, well, what can it do? And what are some of the kind of proofs of concept we can do? Now we're really looking at how can you implement this in the marketplace, the traditional financial marketplace. So what information do you have to provide to regulators? What policies do you have to operate this at scale? For example, we have in the EU under the Markets and Crypto Asset Regulation, or also called MiCA, it's very clear what a credit institution has to do in order to be able to offer various crypto asset services, relying on this Article 60 notification process, and clear about the advance notice that's required, the supporting documentation that's required, and so on. Similarly, in Luxembourg, they've recently adopted legislation that refers to as the blockchain laws 1 to 4. And those provide a clear framework for how you can use blockchain technology when issuing securities and transferring securities. And then finally in the UK, we're also seeing a focus on consultations around how you can have tokenized money market funds and what the various structures that can be used. So we're really focusing on implementation. I think a second key factor over the past 12 to 18 months has really been the stablecoin policy in the U.S. and the adoption of the Genius Act and kind of moving into now the prudential supervision of stablecoin issuers and the way the assets are custodied and held. And so that has kind of brought a real focus on the cash leg of digital asset transactions, a lot of clarity. And since most stablecoins are in the form of or related to U.S. dollars, the fact that there is now a clear U.S. rule about how to issue those that will be recognized under U.S. law, that's really kind of created a lot of focus on digital assets and creates the clear ability for the cash leg associated with tokenized equities or other instruments.
So, Justin, you mentioned that the technology is there, the regulation now is catching up, and it's almost caught up, right? So we're going from experimentation to institutional scale adoption. Maybe you could summarize just across all the domiciles where you're seeing all this activity, like what has really changed, or what signals are coming from all those key regulators that people who want to get involved here seriously, what they need to look out for.
Yeah, and there's definitely been a clear development there. For example, we're seeing really focusing on the operating models and how the operating models differ across the markets, and so differ while at the same time having a lot of similarities. So, for example, in Luxembourg, which is a big market for mutual funds and UCITS and so on. As I mentioned before, they've created this blockchain laws 1 to 4, and they've really created a clear method for how you can implement a tokenized fund. At the same time, it's really important to understand the different ways in which shares are issued in Luxembourg, so that you can have a tokenized money fund that's represented by a token, but that token can represent different things depending on how the shares are issued. So, for example, is it a registered share model, or is it a dematerialized share model? Those two things are quite different. Luxembourg supports both, but it's really kind of going beyond what the token is, looking at, okay, what does it represent? What are the rights and obligations of it? And then how can we implement that into, our institutional processes? As I mentioned before as well, the UK, working through the Investment Association and the Financial Conduct Authority, they've created this blueprint model for fund tokenization and how it's possible to tokenize a money fund under UK law. They're conducted a consultation regarding how you can move beyond that blueprint model and how you can think about other ways in which the shares could be issued, and this concept of a direct to fund dealing model, which would be something new for these tokenized fund shares, really kind of looking to how to make this more scalable and showing that there is regulatory support for this innovation. They're not trying to see, well, it's just risky and we need to control the risks. It's what can we do with this? And we can put controls around things, and we can make sure that we're managing the process, but we're trying to figure out how we can rethink what we're currently doing, and can we make it better using this technology with appropriate controls.
Great plaudits to the regulators here, isn't it? There's advantages, but there's risks, and they seem to be taking, a risk-based approach. Would that be fair?
I think that's fair, and I think that's kind of a change that we've seen over the course of the past 5 years, for example. And the shift has been kind of the most dramatic in the U.S., where it had been very focused on risk, and over the past 12 to 18 months, it's really shifted more to innovation and how can we have responsible innovation. I think Europe had made that shift earlier, although it does vary across some of the markets. But I think the EU is largely been very forward looking, and we're really getting into the implementation stage. And then the UK is really coming along now with trying to figure out how do we make this work. And a number of regulators in Asia, similarly the HKMA in Hong Kong, the MAS in Singapore, and the Japanese Financial Services Agency, they're all working to figure out how to responsibly incorporate this innovation into the market.
How about the Australian market?
The Australian market is definitely, it's moving a slightly slower pace, but it's kind of a thoughtful approach as well. I do think there is kind of a consistency across, like, for example, in the UK and Australia, both are common law models as opposed to the civil law approach that we have in majority of the EU nations. And so that does kind of create a little bit more, I think with the common law, it's more interpretive, whereas the civil law is more prescriptive. So kind of the clear prescriptive side of under the EU is progressed further, but I think we're starting to see those common law jurisdictions come along quickly now.
So just in my mind, when I was listening to you talk, I was thinking about regulatory clarity versus uncertainty, right? We know when it comes to policy, you want to have very good clarity for participants. So when you look at the market and globally, where do you see sort of the most meaningful regulatory clarity, and where do you still think there's a lot of uncertainty?
Yeah, so I think the kind of the clarity is where we see frameworks that kind of provide an end-to-end model. So by that I mean they talk about how do you authorize an entity to perform a certain function, but then going into, well, what do you expect that entity to do when it's in that function, and looking at things of how you would custody assets, for example, and what kind of role supervisors would have and what they would be looking for when they're supervising those activities. And so, again, we mentioned MiCA in the past, but I think MiCA is one kind of the EU market infrastructure rule, crypto asset market infrastructure rule that's really, it does look at the process front to back. And while it was implemented a couple of years ago, we're really now seeing in the past 2 years the finalization of a lot of the implementing regulations. And so now it's fully implemented, and you do have that full front to back approach. In the U.S., we've talked about the Genius Act, and that has brought a lot of clarity. And we're now getting the implementing regulations coming in from the Treasury and the various prudential regulators. So that's also providing that front to back clarity. I think one area where we still have a decent amount of uncertainty is in the U.S. and in our market structure regulation. So there was an act that was passed by the House of Representatives called the Clarity Act, which would identify how you handle cryptocurrencies. Essentially, would be regulated. That's kind of stalled once it's got to the Senate, and there's kind of been an issue, particularly the core issue right now is around whether these instruments the stablecoin instruments would be able to pay interest or rewards on those. But that's kind of caused the bill to be stalled generally. So it's not really moving forward. And the bill would provide a lot of clarity about how which regulator would cover crypto assets. Would it be the SEC or the CFTC? And it would clarify how you would make that determination. It would also talk about roles and responsibilities for custodians and so on and so forth. But that has really been kind of held up. So the U.S. is still lagging in that regard.
Mm-hmm. And then just turning briefly to stable coins, because they're now a fundamental part of the architecture in the digital assets landscape. I think there's been greater clarity in the US, etc. Maybe just talk a little bit about remaining uncertainties around issuing and the backing and use of stable coins in the institutional market infrastructure.
Yeah, I think that it's becoming more clear, for example, what a stablecoin issuer needs to do to register as a stablecoin issuer and how it can be recognized as something that is approved. Where we now have some challenges is that because we have multiple markets issuing stablecoin legislation, while the high level themes are very similar, there are distinct differences amongst those models. And so, for example, you have in the U.S. Very prescriptive requirements as to what assets can be used as the reserve assets backing the stablecoin. And you can, in the U.S., you have to use an approved U.S. stablecoin or an approved foreign stablecoin that's been approved by the U.S. In the EU, they have MiCA, which approves stablecoins, but it doesn't have the same backing requirements that they have in the U.S. So is a stablecoin that's issued in the EU able to be used for payments on transactions that are occurring in the US? That has to be clarified and worked out.
Justin, just building on that, right? I mean, when you think about it, so if every country's got different regulations around stable coins, then what does that do? Like, is it going to create like market opportunities, inefficiencies? Is it not going to, like, my mind, I can't even imagine what that all means,
Yeah, I think it can definitely create, market inefficiencies. I think you'll need to have regulators working with one another to figure out, okay, how can we have some comparability determinations to say, well, this stablecoin that's issued under this rule meets enough of the requirements that I have set in my jurisdiction to be recognized, and that will help kind of get the market to a better place, but that will take time. I think it also will, the fact that you do have these different rules regarding stablecoins that they have the kind of these nuances that might be different, does identify a challenge that we have with stablecoins. And the fact that they're being used as an alternative to cash, but they're not the same as cash. They're not as transferable as cash. So, for example, if you had what's called a CBDC, a central bank digital currency, which would be a digital instrument that's issued by a central bank the same way they would issue in the US a dollar bill, they could issue a token that's a dollar bill, and that would have the same value regardless of where it was in the world. And so when jurisdictions or central banks issue currency, it has the backing of the central bank. Whereas with stablecoins, it's the backing of a corporate entity. And so you have to look at, well, how do you determine what it's worth? It's not, you don't just look at the central bank and it says, well, this is worth my currency. It's something that is, it's an independent party who is saying, this asset, I've got backing for this asset to have it be valued the way it is, but you're reliant on me telling the truth that the backing is there, that when you come to redeem that stablecoin, I'll be able to redeem it for various fiat currency. And so that it is a challenge with stablecoins that it could impact how widely do they end up becoming the full alternative to cash, or is it kind of lesser in the institutional space?
I mean, Justin, it's such a fascinating area. You could actually talk, or you have a symposium on this, right? Obviously, we don't have enough time this morning, but I do want to push on to the whole area of, governance, risk, custody. How should you look at this from this area from those perspectives?
Yeah, I think the a key aspect here is what is the asset, and is it legally recognized as a record of entitlement? How does safekeeping and control of a digital asset work? What happens when you have an insolvency and kind of the bankruptcy remoteness of the custodial entity? How is that respected under the law? So I think those are kind of key aspects that need to be determined around governance. Those are some of the key issues that need to be determined when looking at how the regulations influences decisions around custody, governance, and risk management. I know we have kind of on a governance and resilience standpoint. Regulators are clearly expecting clear documentation around operational readiness. So this goes to, well, if you have a register of shares, where is the definitive register? Is it on chain or is it off chain? What do you use for backups and business continuity? This is kind of new technology. What happens if something goes wrong with the technology, particularly where it's distributed ledger technology and it's not clear exactly who owns or who runs that technology? What happens from a resiliency standpoint? And in kind of risk management and financial crime, there are heightened KYC and sanctions expectations, and so it really needs to be, that's a clear focus of any institutional service provider creating their solution and making sure that they have kind of thought through and clearly identified how they are going to manage their AML and sanctions obligations with this new technology.
Ty, can I jump in just before we wrap up? So what I was thinking is one, thank you. It's been a great conversation just to understand some of the highlights, but there's so much here, right? There's so much, and you're talking about all different countries and regions and all doing different things and trying to understand it all. So I would just say to our listeners that if they are interested, Justin writes regularly for Digital Digest. On statestreet.com, you'll find the Digital Digest, and there's a more detailed, probably wrap of, all the regulations you need to think about around the world. So it's a fantastic resource. So I would just urge everybody to go look there, just if they're interested and want to learn more.
That's a great call out, Anna. And thank you not only for the conversation, Justin, but for everything you've done for State Street and for our customers, because I know you've talked to our clients as they navigate this what could be a perilous journey, but certainly it's one where we've made a huge amount of progress in the last number of years. So thank you for that.
Exciting area.
And I hope, and Anna, thanks for your questions, and thank you to our listeners, to everyone listening in. We appreciate your time spending with us, and as we shape the future state, I think what I've learned from this is really the importance of keeping up to date. This is fast moving, and moving not only with momentum, but with huge importance for the shape of the capital market. So thank you again.
Great. Thank you very much. Appreciate it.